Last week was great, but let's not forget we are still in a bear market. And a bear market tends to have multiple relief rallies, only to surprise us with new lows in following weeks or months. We may have bottomed or are in the process of bottoming. I don't know. I do know that inflation, interest rates, recession, and geopolitical news continue to make headlines, which means we will see volatility in the short to medium term. Let's talk some strategies you can think about in the current environment. Hey friends, welcome to Think Finance. My name is Raj, and on this channel, I like to talk money, stocks, crypto, 401ks, and everything that hits our bottom line. I just got back from vacation. My son and I visited Spain and Portugal. It felt like life is just perfect. Are global economies really slowing down? And do people really care about inflation? Sure didn't feel like it. The fact is, inflation, recession fears, and rising interest rates is all real and is putting a strain on our money. If it makes you feel better, some of the smartest people out there have lost billions, including these guys. So in this video, I want to share a few strategies I believe we should consider as we deal with a volatile bear market. Of course, you can short the market, but that is not something I'm going to discuss today. Take a look at this video for some more strategies. Today, I'm going to call out specific strategies to consider. I strongly believe in buying the dip in the stock market. Assuming you have a long-term time horizon, buying the dip is a no-brainer. Long-term time horizon does not mean 3 months, but more like 3 years or more. Typically, you want to automate your investing. Automatically invest a fixed amount on a weekly or monthly basis without worrying about what the market is doing. Every few years, markets correct, which leads to an opportunity to buy stocks at a discount. We have one right now where stocks are down 25 to 30%. Can it go lower from here? Of course it can. No one can really time it right. But if you put new money to work today, you are buying the market 25% cheaper than what it was a year back. The whole idea is to bring down your average cost, dollar cost averaging, or DCA. In the short term, it may sound like a bad idea as the market continue to grind higher, but in the long term, you will build wealth. I typically recommend buying dips at regular intervals. For me, I end up buying the market every time NASDAQ falls 10%, 20%, and 30% from the highs. With this recent drop, I did end up buying at these levels. Can we drop 40%? Sure we can, but I'm sure I'll end up buying more. It's a great time to consider Roth IRA conversions and setting aside money for education. If you have money lying around in traditional 401ks or IRA, it might make sense to convert into a Roth account. Withdrawals from Roth account is tax-free, so if you believe that the market will be much higher than where it is today, years from now, might make sense to convert and enjoy tax-free withdrawals in the future. Or maybe think about funding your kids' 529 plan. When 529 funds are used for qualified education purposes, there is no federal income tax on investment gains, meaning no capital gain tax. Again, you're betting market will be much higher when your kid needs the money for education. I recently moved a big chunk of funds into my son's 529 account. Some ETFs to consider. Inflation will be the story for the rest of the year and maybe into 2023. RAX is an ETF focused on managing inflation risk. A lot of allocation is in high yield, gold, energy, infrastructure, and real estate. Compared to S&P, RAX is actually up 2% year to date. Next is GMOM, another super interesting ETF. It focuses on momentum and current trends in the market and appropriately adjusts where to invest to minimize risk as much as possible. For example, inflation, interest rate, recession, and geopolitical issues is the current environment we are in. The ETF will focus on investing in areas that can either take advantage or help reduce risk given the conditions. Compared to S&P, it's almost flat for the year. Monthly dividend ETFs are also appealing in this environment. There are tons out there, but my fave is QYLD. This is one complicated ETF, and I have a whole video dedicated to this, so do watch that if you need more information. The ETF is currently yielding around 13% and will provide some downside protection if you expect the market to go down further. You're buying this for the juicy monthly income. Final one I have for you is SPYD. Maybe you're someone who is not a huge fan of volatility and is looking to invest in quality where you can get some decent yield. SPYD focuses on high-yield S&P companies. The ETF yields 3.6% and compared to S&P is only down 4.5% year to date. Let's say you have a bunch of Apple shares. You can consider selling covered call options on these shares. A covered call is a popular strategy in the options world to generate monthly income. Per definition, call options give the buyer the right but not the obligation to buy shares at a set price. If the option buyer does not exercise the call option and it expires, you get to keep the premium and can continue selling covered calls against the same shares, receiving additional premium payments. This topic requires a separate video, but the quick takeaway is selling covered calls is a smart way to generate monthly income and reduce your overall cost basis on your Apple shares. I hope this made sense. Depending on your portfolio, risk tolerance, and time horizon, there are other strategies you can think about. Take a look at this video for some more inspiration. That's all I have, guys. Thanks for tuning in. Let me know in the comments how you're managing this crazy market. Until next time, peace.